Volvo CE is a Chinese company as well. SDLG, which we are the majority owner of, is the premier Chinese domestic wheel loader manufacturer and distributor. And we own 70% of that through a JV. SDLG for a generation has held the #1 or #2 spot in China on wheel loaders, and the product line is more expanded and also a strong export business. But China, from this very high levels, these very high unsustainable levels where it was 450,000 units, then had I would say, a similarly significant correction. And that correction, when you have high highs, then it's often followed by low lows. And that's what we saw in China, one of the most dramatic growth and then correction stories I've seen in my 30-plus years in this industry. China now, after many periods of bumping along the bottom, we're seeing, and we've seen for a quarter or two, improvements in the Chinese marketplace. It started with the general excavator business, and now slowly starting to translate into the wheel loader business as well. It's not yet time to call it a high growth market. It increases in unit sales and customer demand from very low levels. But we're seeing a stabilization there that's good to see. Generally speaking, if you look at 2016 to 2017, you add up these curves, it's about a flat market, maybe with some increases. So the general story of Volvo CE consistently is we don't rely on the market to drive increased performance. We look in the mirror, we rely on ourselves. Ours is a story of self-help to drive continuous improvement while we're maintaining industry-leading positions. So as today, markets start to come back, we're there to grab that business, satisfy that customer demand, and continue to take market share from our competitors, which we've been doing successfully for many quarters now.